Hey everybody, back with another dividend analysis, and today we're going to be looking at Foot Locker Inc., or simply FL. Going to be looking at Foot Locker because I've gotten a lot of requests for it, and I'd like to get it out of the way. So as always, we'll start by looking at the yield, currently sitting at about 2.2%. Nothing to write home about. It is doing better than the wide market, than the S&P, but it is not particularly high, so just keep that in mind. Going back over the history, we can see that in 2013 we would have been getting about 20 cents a share, while currently we're going to be getting 30 cents a share from this last payout in October. So we do have some growth there, but we do need to look at this as a whole over this time period. We did have a lot of growth going from 20 cents up to 40 cents until 2020, and everything went and hit the fan. Then the dividend was slashed by over half and is currently trying to make its way back up. So if you're a dividend appreciation investor, this is something you have to look at. When times got tough, when things happened, they decided our dividend isn't what's important for us. We're gonna cut that instead and focus on other things. So if appreciation matters to you, this is something you need to look at. It should, warning bells, sirens should be going off if you're that kind of investor. This is the kind of thing you don't want to see. Keep that in mind. Next, let's go ahead and look at the financials. We'll start with the free cash flow as always, and we can see that free cash flow has been increasing over the past 5 years, technically almost doubling, up like 80% over the last year, and up about, about 65% over the last 5 years. However, this last year has been a huge jump, going from 500 million, really sitting in the 500 to 600 million range, up to 900 million. So this is probably going to be an anomaly. They had this relatively large drop in 2020 for obvious reasons. People weren't going to be buying as much, and then after that pent-up demand surged out, they were able to almost double that free cash flow. So I would really see this as an outlier. The only way they're going to be able to maintain numbers near this 900 million mark is if inflation really is as out of control in the future as it is now, and money just becomes worth less and less. I would expect to see this normalize back down to around 600 to 700 million. That would make a lot more sense. It would very much show that this is an outlier, so just keep that in mind. Checking out the ratio of free cash flow, if we do go by the last year, however, Foot Locker paid out about with that 40-cent dividend, they'll be paying out about 125 million in dividends, and of course, this is going to be easily covered, sitting at about 14% of current free cash flow. However, as I said, that's probably going to go, that free cash flow number going to go down, and that percentage is going to go up. But even if they do drop back down to the 500 million range, 600 million range, they're still easily going to be able to cover that well under that 50% ideal range. No big issues there, so that's good to see. Heading over to the income side of things, we'll check out the ratio of income, and see they're currently sitting at $323 million in net income, and if we do our calculations there, that's about 39% of net income is being paid out as dividends. Again, decently under our 50% ideal range, even if their income drops, which it does seem to be doing over the last few years. They're going to be able to keep that dividend being paid. Now, their income is down about 50% over the last 5 years. However, there has been a decent spike in the middle of there, but it is very inconsistent. I would be looking at this. Why is that income so inconsistent? You could probably strike out 2020 for obvious reasons, but why did they go from 660 million down to 320 million? Why are they making such less profit? Does it have to do with margins? Are there write-offs, things like that? You really want to see those kind of things. And why is this income, 323 million, so different from their free cash flow of 900 million, free cash flow being almost 3 times what income was? That's very interesting. I'd really want to delve into that, see what the issue at hand is there. Why is this occurring? Going over to how Foot Locker is making their money, there's the simple things. They sell shoes. They also do brand some stuff and things like that, but the vast majority of their business is selling shoes. And it is a market. It makes sense. The only thing that would concern me here is if there is some kind of economic issues. People aren't going to be buying, luxury shoes, things like that. This is something that would definitely take a hit. This would be something that crashes with the market. So just keep that in mind. If you think the market's going to keep going as it is, people are going to have, money to spend on luxury items, there you go. If not, this would probably be something that you might not want to look at so much. There'd be, it's definitely not a consumer staple, is a good way to put it. So who should be looking at Foot Locker? Is it useful for you? Does it belong in your portfolio? From an appreciation standpoint, it is going up technically, but the cut in 2020 is worrisome. Knowing that the company, if things get tough, the dividend is going to be the first thing to go. If you're a dividend appreciation investor, that really should make you stop and think. I would definitely, really, really think hard about something like this if I was a dividend appreciation investor. Is this worth that risk? Is it worth putting money that I'm expecting to grow over time, that I'm expecting to get more over time? If something goes wrong, that strategy kind of falls through. So just keep that in mind if you're looking at the appreciation side of things. From an income side of things, it's, 2.2% is not much. Really, it's just barely a dividend ticker, just being over 2%. And really, it seems like its time has sailed with its recent increase in price, going from, what did we have? Going from, 46 back at the beginning of 21, being under $40 to 55 now. I mean, you had a much higher yield back then, even though the dividend was a little bit smaller. The ship has probably sailed on this in terms of income. You could still include it, if you're thinking, I think the company's going to do really well. I like the way it's structured itself. I've gone over the financials. I really like this. Plus, it pays that 2% dividend. Then it could be in, an income portfolio as something that's generating you a bit of income while also being a play on just being a good company. But from, just a general income side of things, trying to get income out of something, probably not what it's for. Really looking at it as a whole, this is really one of those stocks that it's not a dividend stock. It's a stock that happens to pay a dividend. When you're looking at this company, you're really looking at it for other reasons first. The dividend is just something on top of that. It's an icing on the cake kind of situation. So just keep that in mind. And as always, I hope this helps, and thanks for watching.